offline about this. I'm going to propose that we talk about this probably either on the 4th or the 11th. There's a couple of tutorials. I've already watched one. I need to watch a few more so I can get smart on that. And then there was another question about step-up basis. And for those of you who are new or fairly new to the VITA program, when you hear the term basis, that's really an accounting term. It really means cost. And then when you hear the term adjusted basis, that means the cost has been changed, and that's why they call it adjusted basis. So quick example, you buy your house for $700,000. The basis in your home is $700,000. And then you decide to put a swimming pool in where a swimming pool does not exist, and that pool costs you $100,000. That means your adjusted basis on your property is now $800,000, $700 for the original acquisition, and $100K for the installation of the pool. And so when you're talking about step-up basis, what it is just kind of the general rules. It adjusts the cost basis of what is called inherited assets. And so that means someone passes away and someone inherits, and it could be a spouse, it could be a son, but anyway, it adjusts the cost basis of inherited assets. And what it does, it reduces the capital gains tax. That's the whole thing about step-up basis, which it's a good thing for the taxpayer. And then the step up goes to what is called fair market value. That's the general rule. And so what that does, that eliminates capital gains that occurred between the purchase price and the heirs acquisition. And so that's basically that. And again, Sean, we can go off line, Mel, Sean, and if you want, maybe that last day on the 11th of December, I can have an example where we can talk about real property, i.e. a house, where you might have either a community property, or you're holding it in community property, or holding it in joint tenancy, something like that. But that's step-up basis. And you do hear a lot about that. And quite frankly, I think I've seen that once or twice in VITA, but I'm sure you guys at the church have seen it a lot more than I have. Okay, all right, so let's see then. Let's go ahead and do this. Let's jump into today's activities. And let's see, I'm already frozen here, Sean. Not a good sign.
You might want to try unsharing and sharing again.
I'm going to do that. Okay.
There we go.
So here's our objectives. We're going to do a quick review. We've already talked about the WIN tax return, a couple things I want to address, and then we'll jump into standard deduction, the various credits. We'll spend a lot of time on the child and dependent care credit, the education credit, and then the child tax credit, as I mentioned the first week, that has changed significantly, certainly for the better for parents that have qualifying children. And then we'll talk about that $500 credit for other dependents. And then we have a tax return called the Gene Arista return, and we'll get into that toward the end of the session. Our session is going to go from 9 to noon. We'll take breaks at about 9:50 and 10:50, or as directed by competent authority at the church. Okay, so the team, by now you should know the team. The players include Sean, the guy that I'm talking to. He's the training coordinator. And then if I understand things correctly, Mel, you're running the show this year. Is that correct?
That's what I heard.
All right. So Mel's the guy. If you have any problems or you want to raise, go to Mel. Okay. So we talked about the David and Ali WIN return last week, and someone said the check figures didn't check. You are absolutely correct. So I'm going to give you those check figures. Your federal refund should be $2,272, and your California refund check figure should be $1,034. And what happened on that one? I can't believe I made this mistake. The first mistake I've made since 1983, but we did not include the jury pay when we were going through that example with Sean last week. Okay, so any questions about the David and Ali WIN tax return?
And if you have questions, you could just type it in the chat because everyone's muted now.
Okay. All right, and like I say, we'll stop from time to time for questions. Okay, a couple things about the practice lab. I was in there this week two or three times. I was in last night, and yes, the 2021 it is available. It is less clunky than it was last week, and as of last night, the state returns were not available. And so my understanding, what happens with that practice lab, the people who put it together, they hang it on the website there, if you will, and then they start to improve it or update it or fix it as the weeks go by. So my understanding is by the time that we are done with our VITA sessions, that thing should be running full steam. But again, you can still practice on your federal return for the 2021. And then, as I mentioned before, there are tutorials. I've used the tutorials before, and I think they're okay. It just depends on your point of view, but there's a lot of information, especially if you are new to VITA or you need some refresher training when it comes to navigating the software. And then there are practice returns. Those practice returns, they do have what are called check figures or solutions. And so that's additional training for you if you choose to use it. And then let's see, Sean, how many new folks do we have today? Do we have a count, or are we still at onesies and twosies?
Well, we've got 48 people on the call today, Jerry, and looking down through the list, there's a few people who do not have a name that is a human name, but other than those, I don't see a lot of new people.
Okay.
There's probably about 3 new people on this call.
All right, and I mentioned before, thanks, Sean. If you are new, or if you're fairly new to VITA, this I'll be quite candid with you. Sometimes this can be quite overwhelming, but I'll say this to you: as you go through the training, as you go through the season, you have a lot of people out there who are willing and ready to help. You got smart people. You got Sean. You got I think Scott. He's on the call. He's a pretty sharp guy. You got a lot of people in the VITA program, and so you're not by yourself. You got help. And if you do make a mistake, and I'll tell you what, I make mistakes all the time on tax returns, but in the VITA program, we have 100% review, and so that helps out a lot. So you're not alone. You have people to give you guidance, to give you instruction, to hold your hand. So I think you're going to be okay. And as I tell people in the VITA program, when you do about 10 returns, you really feel confident. You start to navigate, and you feel good about doing returns. That first one can be a little intimidating. Maybe you're a little nervous, but again, all that goes away in just a few short days as you prepare returns. Okay, a couple things about the standard deduction. Something that you don't have to memorize. It's certainly in the publication 4012, but all of this is done automatically in the software. In fact, there's a lot of things that are done automatically, but it's nice to have that knowledge when people ask you why. And when they ask you why, you're able to go to the return, you're able to go to the publication 4012 or other IRS documents and say, well, this is why. So again, the standard deduction, the rule that we use in VITA is it's either or. You get the standard deduction or itemized deductions, and there's an exception to that. We don't talk about that because in the California VITA program, we do not prepare a married filing separate returns. That's the general rule. Okay, so here are the standard deduction. It's gone up a little bit for single folks. You can see that on the screen, $12,550. Married filing joint or qualifying widower with dependent child, it's gone up to $25,100, and the head of household up to $18,800. And then something to be aware of when you're talking about qualifying widower. You see this a lot on the VITA program. Someone will come to the site. We're talking about tax year 2021 right now, the current calendar year that we're in. So you might have someone who loses a spouse in calendar year, i.e. tax year 2021. So when they come to the VITA site next year, they'll let you know they've lost their spouse. What that means is they still can file married filing joint for tax year 2021. And then if they have a dependent child or children, then in tax year 2022 and tax year 2023, they can file qualifying widower with dependent child. But again, in the year of death, they can file jointly. And then, of course, what will happen is the surviving spouse will sign for the decedent, of course, electronically in the VITA program. Okay, a couple of the things that you see, I've actually seen this this past season. We do have a lot of seniors at the St. Killian's site, and so they get an additional amount on that standard deduction. It's computed automatically. And then you might have what is called an individual who meets the tax definition of blindness. And the tax definition of blindness is says you can't see better than 2200 in your better eye with corrected vision, or your field of vision is 20 degrees or less. And so that is the tax definition of blindness. And so when you are talking to someone, they're going to fill out that intake and interview sheet, and they're going to tell you a bunch of stuff. And one thing they're going to tell you is if they are blind according to the tax definition. And over the years, some people ask about that and they say, yeah, I've got problems with my eyes. And I say, okay, well, do you have an eye doctor who has given you some type of diagnosis? Have they measured your eye acuity? And that's something you're going to ask about. And then, as I mentioned before, I had a taxpayer who I did a Zoom interview with last season, and I didn't notice anything. And she finally said, Jerry, you probably don't notice, but I'm blind. I said, no, I didn't notice that. She goes, yes, I'm totally blind. And then I explained to her, I said, okay, when we do the return, what will happen is because you're taking that standard deduction, you're going to get an additional amount on the standard deduction because of your eyesight. And so you may bump into that from time to time. And then, of course, if you go to page F2 in your publication 4012, there's a deduction worksheet for dependents when they can be claimed, i.e. by their parents. So again, all of this is built into the software. This is something you don't have to memorize. But again, when people ask you questions, it's nice to go to the tax form and say, this is the reason why the standard deduction is X. And it's actually stated on page 1 of the form 1040. Okay, any questions before I move on?
Jerry, there's one question in the chat. It's kind of a long question about short-term and long-term transactions on a 1099 Bravo.
Okay, and what's the general question?
So the question is, when you summarize several transactions on one line, what date for buying and selling are you supposed to use?
Well, I'll tell you what I do. I don't know what Mel and the powers to be are going to do at the church, but what I do is I usually just split the difference, because when you aggregate, it doesn't matter, because you're going to aggregate short-term or you're going to aggregate long-term. And there might be some instructions in the instructions to the form Schedule D. But again, when you aggregate, all you got to do in my book, you just aggregate short-term and then you aggregate long-term. So hopefully that helps you out. But again, I would encourage you to talk to Mel, and you might have some additional guidance. Okay, anything else, Sean?
No, that's all I saw.
Okay. All right, so let's talk a little bit about the child and dependent care expense credit. This particular credit has changed significantly. There we go. For tax year 2021, and some of the same rules still exist. You're talking about someone who is dropping typically their child off, or their child is being watched by someone, because that person is either going to work, that person is going to school, or that person is looking for work. And this particular credit for children, the children have to be under 13 years of age. So what that means is, when they reach 13, you no longer, even though you're paying expenses for someone to watch that 13 or 14-year-old kid, they're not part of what are called qualified related work expenses. And so again, that age 13, that's the drop-off point. And then also you have what are called people incapable of self-care. And that could be a spouse, or it could be someone who is over age 13. And when you're talking about incapable of self-care, if you jump into publication 503, it talks about they're unable to cook for themselves, they're unable to clean themselves, and things like that. So basically, they need constant attention. And if they meet that particular definition, then if you're paying someone to watch that individual, typically it might be an adult, and you're paying so you can go to work. That's part of your qualified work expenses. What I've seen in the VITA program, I've seen a lot of different things, but typically you're talking about minor children under age 13. And then your work-related expenses, that's again, the typical example is you're paying, like when my son was under 13, we'd drop him off at the babysitter and we'd come back at 5 or 6 o'clock and pick him up. And I would go to work, my wife would go to work, something like that. Let's see, overnight camp. This is something that I've seen a lot. If you kind of go back in your memory, or maybe if you have kids or grandkids, if you drop your kids off at a camp, there's different types of camps. You have what is called a day camp, and that's they run around, play games during the day, and then of course you pick them up. That could qualify. But overnight camp, that's where you drop them off at Camp Snoopy, and they have arts and crafts, and they have a campfire and roast marshmallows. So when you're talking about overnight camp, that doesn't qualify, but day camp, it does qualify. And then if you might remember the old rules from, I guess, last year and the year before, your expenses, the maximum, even though you may have paid more than that, the maximum used to be $3,000 per kid, $6,000 for 2 kids. And now that's changed to $4,000 and $8,000. And then up to 50% of those expenses are refundable. And so what's going to happen when you get into the 2021 tax software and you enter data regarding expenses, you're going to see on that worksheet there's a refundable amount. So this is a big change. And I think what's going to happen, I think a lot of taxpayers are going to walk away with a large refund, which is a good thing, because obviously the whole intent behind the program is to help out low and moderate income taxpayers. So you're going to see this is a big change. And I was looking at the current bill that, well, at least it passed the House of Representatives, that Build Back Better, if I got that right. That also has a bunch of tax law changes, but we're not going to talk about that because it hasn't even passed the Senate, hasn't been signed by the president, but more to come on that if it addresses the 2022 year, just FYI. And then earned income and deemed income, that would be a situation where that plug figure, that's the term I like to use, when you have someone who is going to school, obviously they're not generating income, but for the purposes of this credit, you can enter what is called deemed earned income into the software. And that's a good thing because, again, it generates that child independent care expense credit. And something that you will see, I think, a lot, I've seen this a lot ever since I started working with this credit. You have people who provide for a child, and that person might be a daycare center. In fact, there's one next to St. Killian's Church. I forget what they call it, tutor time or something like that. So people will drop off their kids. That is most likely an incorporated entity. And so what will happen at the end of the year, the child care provider will give the parent or parents a bill, of course. And then also they're going to give them information pertaining to that child care provider, the name, the street address, and then the employer identification number. When I dropped off my kid years ago, one of the first, and the babysitter knew that I was an IRS agent. I asked her, hey, what's your social security number? She goes, why do you need to know that? I said, well, that's really easy. I'm going to take the child care credit on my tax return, and I have to provide the social security number of the provider, along with the name of the provider and then the street address. She goes, okay. And I guess maybe she was sticking money in her pocket. No one ever asked her that before. And then what would happen is I put that on the return. And then when I put her name and her social security number and her address in the tax return, it goes to the big IRS computer in the sky. And then what happens is the IRS will look at that particular entry to determine if that person is filing a tax return. And that's called the whipsaw effect. And so there are individuals out there who, and I've met them, who simply do not report this income, and they should report the income because it's self-employment income, and they most likely have a filing requirement. And so if you bump into someone who's a child care provider, you might want to mention to them, if they're not reporting their income as a provider on their own tax return, they should do so. And then sometimes you're gonna bump into someone. People use various terms. I think the term we use at the church is undocumented. So this would be a person who's living and working in the United States and they haven't gone through the regular immigration channels. So those individuals, they may very well meet the substantial presence test. So what that means is they have to file a tax return because they're receiving income as a provider. In that particular case, those individuals should apply for an ITIN, which is an individual taxpayer identification number. And although this used to be a big topic many years ago, I really haven't heard much of it, but sometimes you'll bump into people and they'll say, well, will immigration come get me if I file a return? Well, the short answer is no, because the IRS, they're not in the business of sharing data with the immigration service. And so your taxpayer, all they need to do is just meet the tax requirement of filing a return if they have a filing requirement, get that ITIN. And then I mentioned a little bit about due diligence, kind of danced around it, but this is important. You want to ensure that you obtain all the information you can as the parent from the child care provider. And I would think if you're a parent and you're dropping your kid off with someone, you want to know a little bit more about them. In some cases, individuals are bonded, but the bottom line is you want to know their name, their address, and some type of identification number. And then the last I heard is if you have an ITIN, the last I heard you can electronically file a return. And if that's changed, someone on the call correct me. But again, you want to make sure you do your due diligence. Okay, I'm going to go ahead and stop here for a second, see if anybody has a question.
I don't see any questions in the chat, Jerry.
Okay, great. Let's go to the next slide. All right, this is something that I see, and for those of you who are new or fairly new, I help a little bit out at St. Killian's, and then I'm also the site coordinator at a local community college, Coastline. And so we see a lot of taxpayers who are attending some type of college, and a lot of them are eligible for what is called either the American Opportunity Tax Credit or the Lifetime Learning Credit. And of course, when they go to college or they go to some what is called post-secondary education, I had to look that up many years ago. I thought, what is a post-secondary education? Well, that means you graduate from high school and you either go to community college, you go to a trade school, or you go to some type of four-year college. And that is a post-secondary education institution. And so if you're going to take a tax credit, one of those education tax credit, which we're going to talk about, you have to attend one of these schools. And we're talking about a school that is enrolled with the United States Department of Education in their grant and or loan program. And so if you look at the very bottom of the screen, it talks about, these are just some examples. So Saddleback College is a local college, not too far from the church. That's eligible. And so if you have a student who's attending that school and they're paying tuition, out-of-pocket tuition, or they're buying books, that all goes to what is called a qualified educational institution or an eligible one. And then Cal State Fullerton, a four-year school up the road, that's another one that's eligible. And I looked up a couple that are not eligible. There's a school called the University of Honolulu School of Law. It's not in Honolulu, it's in Modesto. That's not eligible because they do not participate in that loan and grant program. And then, and I'm not poking fun at the school. It may be a good school, it may be a bad school, but it's just a school. And then here's another school, again, not poking fun at it. It's called the Approved Real Estate Academy. That would be a school where people go to most likely become a real estate agent in California or maybe a broker. And that particular school, it's not eligible because, again, they don't participate in the grant and loan program through the United States Department of Education. And then the URL, and I was testing this. If I click on that, I think I'm just going to crash and burn here. But you can click on it yourself and you can see that laundry list. Chances are when you're working with a taxpayer, they will present a information return called the 1098 T as in Tango. And that document's going to have pretty much all the information that you need on it. Of course, you do have to ask questions because they may have had additional out-of-pocket expenses. But again, this is your laundry list of schools. And there's a whole bunch of schools in the United States. Here's something else that I've been asked over the years. You might have an individual that is enrolled in the University of California at Los Angeles, and perhaps one of their semesters, they fly off to Rome, Italy for a semester, and they're paying their tuition to UCLA, and they're doing their semester in Rome, Italy. Well, because they're paying their tuition to UCLA, and that's an eligible education institution, that means they're going to be issued a 1098-T from UCLA. And of course, if they have out-of-pocket expenses, they can take the one of the education credits. All right, and same thing, I'm not going to open that up, but if you're interested in the tax year 2021 Form 1098-T as in Tango, it is published, and you can see that on the IRS website. And if you've gone to the IRS website, and I'm not an expert at it, I mean, I've used it as an agent thousands and thousands of times, but there's an incredible amount of information forms on the website. And sometimes you got to bounce around, you got to dig. Sometimes it's a little frustrating finding what you want, but you'll eventually get there. And then sometimes I just go to Google and I Google a form. It's quicker, and I find the form, and I can do it that way. But again, the IRS website, just about any form you can think of, and I don't know how many there are, but there are thousands and thousands of them. And for individual filers, i.e. the 1040, there are hundreds and hundreds of forms. And so sometimes you're going to bump into a form, and every season this happens to me. Someone says, hey, form whatever. I'm thinking, never heard of that one. So I open it up on the website thinking, okay, this is interesting. I see what it says. I've never seen this before. You will experience that in the tax world. Okay, let's go ahead and let's kind of go through this nice and slow, because this is important, especially if you have a young woman or a young man going to college and eligible for one of these credits, or you have parents that have kids that are going to college. And this is these credits are, they're not the biggest credit, but they're a credit nonetheless. And if you can obtain the credit, then by all means, make sure you enter that data correctly in the software, and you're going to get the credit. So let's talk about the American Opportunity Tax Credit. What will happen is, again, your taxpayer is going to complete that intake and interview form, and they're going to provide a bunch of information returns, maybe scratchy pieces of paper with data on it. I've seen all walks, but what you're looking for is the 1098-T as in Tango. And the form 1098-T as in Tango is issued by that eligible education institution. So I had a taxpayer I was working with, and I probably spent 20 or 30 hours, and I thought, well, maybe I probably should disengage. This is not making sense. First question I asked her, I said, okay, where's your form 1098-T? And she couldn't give me an answer. I said, well, what you've got to do, you got to go back to the school, and you've got to ask them to issue a 1098-T. And I don't know if she ever did that, but we went back and forth a bunch of times. I said, that's the starting point. I'm not going to lift a finger until you have the 1098-T. That's what you got to do. And then when you conduct the interview, and we all know this, if we interviewed one person in our life, we all know this. When you're talking to someone who gives you that 1098-T, they most likely have other out-of-pocket expenses. And so you're going to ask them, what about your other expenses? We're talking about qualified expenses. And for the purposes of the American Opportunity Credit, you're talking about course materials. And so an example would be, like I teach a class at another college, and the students, of course, they pay tuition. I think it's about $50 per hour. And then they always contact me. They go, hey, Jerry, I'm ready to buy the book or the second book. And these things cost like $200 a piece. I said, yeah, they're not cheap. And they go, well, I got to buy this for the class. I said, well, yeah, because it's a college class and we're going to be using the textbook. You're going to be reading from the textbook. You're going to be doing homework from the textbook. Yeah, you got to buy it. So you're going to have people who are going to purchase textbooks to the tune of hundreds and hundreds and hundreds of dollars. And for the purposes of the American Opportunity Tax Credit, when they're buying these textbooks, they can buy them from the school textbook shop or textbook store. They can buy them on Amazon. They can buy them from another person, but we're talking about things that they're using for their education. And again, the example would be a textbook. Those are part of what are called qualified expenses. And then, of course, tuition and fees, that's obviously another qualified expense, because when you attend colleges, for the most part, I know there's some examples. I know of one college where certain individuals pay zero tuition and zero fees because of their income level. So they apply, they qualify. But what you want to remember is a 1098-T is going to have information about monies that are paid to the school by the student or on behalf of the student. And then it's not going to reflect those out-of-pocket expenses, i.e. for textbooks. And so you want to have that interview. This is something I see all the time where people say, well, I got other expenses. I said, okay, tell me about them. Now, of course, we know, and I think in the VITA test, it talks about room and board. And I'm going to call in someone. And this is a softball question. Ernest, can you come off mute? Oh, I'm sorry, Ernestine. Ernestine, can you come off mute? Are you still with us? How about no? Oh, there she, hey, Ernestine, how you doing?
I'm fine.
Ernestine, quick question for you. When a student goes to college and they're paying room and board, what does that mean?
They're paying for a place to stay and they're paying for food.
Bingo. Thank you. Okay, so room and board, that's not part of the qualified expenses. And that's something you're going to see people say, well, I'm paying tuition. Also a parking pass. I know when I went to college, I think parking was free. When my son went to college, I think he had to pay like $500 a year for a parking pass. So it gave him the privilege of parking his car for the day. Parking passes are not part of qualifying expenses. And so when you go through all of the expenses you're paying for college, you're really boiling it down to tuition fees, typically on the 1098-T, and then textbooks that you're purchasing for the class. All right, and then the good thing about the American Opportunity Credit, which we're going to go through later on this morning, it's pretty basic. You're going to enter some data into the software, and the software is going to generate either the non-refundable or refundable component. So the American Opportunity Credit, it has both of those components. And when someone asks you, what's the difference between non-refundable and refundable, the answer is non-refundable is a dollar for dollar reduction of the tax. And once the tax gets to zero, well, you can't use any more of that non-refundable credit. And refundable simply means you may not have a tax liability, but with a refundable credit, you're going to get money back. And some people will use the term, it's a negative income tax, but that's the difference between refundable and non-refundable. And then, of course, the max qualified expenses that you use to calculate the credit is $4,000, and that's your out-of-pocket expenses. And then max per student, because you might have a couple students in college, is $2,500. And it's good for 4 tax years. And so what that means is it's going to be 4 tax years, and they don't have to be consecutive, because sometimes people will go to school. I think I did this. I think I went to school for like 3 years, and I thought, oh, I don't need college. And I dropped out. And then I realized, yeah, I need college. So I came back. And so that would be non-consecutive. So again, just 4 tax years. And then the legislation, and this is the only thing I can think of, I'm not saying it's bad, I'm just saying it is. I think this is social engineering, where Congress says you can't have a felony drug conviction. Don't know the congressional intent behind that, but the bottom line is you can't have a drug conviction. Now, this is what happens if for some strange reason it went to some type of IRS examination, and the IRS then has databases and they determine the individual had a drug conviction. What they would do, they would simply disallow the credit. So that's a question we want to ask. It may be an uncomfortable question, but you got to ask it. And then a lot of credits, a lot of things phase out. And the intent behind that is Congress says, if you're making lots of money, you don't need these credits, or you don't need all of these credits, because they're really, a lot of them are geared toward low and moderate income taxpayers. So if you're making $800,000 or $900,000 a year, again, you're going to be phased out of a lot of things. And the American Opportunity Credit is one of those things that has a phase out. Now, we don't need to worry about that because of the income limitations in VITA, but there is a phase out. So if you're doing your own return using TaxSlayer or TurboTax, whatever the case is, you may, let's say you're a well-to-do person, you may say, well, gee whiz, this thing phases out. It does, because again, you're in that higher income group. And then another thing about the credit, you have to be pursuing some type of degree. And if I remember correctly, I think the term is you matriculate. So when I went to college the first time, I showed up, had a broken leg. It was miserable. I went up to the administration building and said, hey, I'm Jerry. I want to enroll into school. They go, okay, sign all these forms. And then they asked me, what degree do you want to pursue? I'm thinking, well, I just want to go to college. They go, no, you got to pick a degree. And so I looked at some board and I said, I want that one. And so that is pursuing a degree. I matriculated and I said, okay, we're going to go ahead and chase after this degree. Or in some cases, a credential. So if you go to some trade school, you might be getting a credential in some type of trade. So again, that's something that's a requirement. And then another requirement, you got to go at least half-time for an academic period. And one thing I've learned, I've attended a bunch of schools and I've talked to a bunch of people who've gone to college, and colleges are like people. Like I went to a college, we had an academic period that was 3 weeks long. And then I went to another college, we had a traditional semester that was 16 weeks long. And so what you've got to do, you got to determine if they want half-time or more, and that's going to be reflected on the 1098T. And then of course, if it's not for some strange reason, they can go back and get a corrected 1098T, or you can contact the college and say, okay, what is at least half-time at this college? Okay, I'm going to pause for a second and see if anybody has a question about the American Opportunity Credit.
Yeah, Jerry, there's actually a number of questions that came in.
Okay, I'll go ahead.
The first one wasn't really about American Opportunity, but on your previous page, you had mentioned using Google. So there's a question about if Google is accurate information regarding taxes.
Is Google accurate information? I guess I'll answer your question this way. If you are on Google and you're looking for an IRS form, you're gonna be able to get that form. It'll show toward the bottom the Office of Management and Budget OMB number. And so the short answer is yeah. If you bring up an IRS form on Google, I'm thinking you're probably going to be about 99.9% accurate. So the short answer is yes. And then what you can do if you want, you can jump back into that IRS website. But again, what I've done in the past, I go to the IRS website and sometimes I just can't bring up the form. And so what I do is said, something, path of least resistance. I'm not going to spend an hour on the IRS website. And I go to Google and I put in form umpty-frats and it pops up.
Okay, the next question I think you've already answered. It was, is there an income limit to qualify for the American Opportunity Tax Credit?
Yeah, there are phase outs. And so you might have someone who has a very modest amount of income, perhaps maybe $8,000 or $9,000 of income for the entire year. And if they meet the rules for the credit, this American Opportunity Credit, they're going to receive it. But again, the phase out that I talked about, you don't need to worry about that because you're not going to have a VITA client that comes in who's making, $80,000 or $120,000 a year. I don't know what, I think I know what you guys would do with the taxpayer like that. You'd simply tell them that this program is for low and moderate income taxpayers, and you should go out and seek a paid practitioner because you make X number of dollars.
Okay, and then the last question, Jerry, is who can receive the education credit? Is it go to the student, or if they're a dependent, does it go to their parents?
If you have typically what you're going to see a taxpayer that comes in and they've got children, young adults, their kids going to college, and they're paying the tuition for them, or they're claiming the child on the return. And so that's typically what you're going to see. You're going to see the parents who are claiming the child, and they're also claiming the credit.
Okay, that's all the questions.
All right, okay. And then lifetime learning credit, again, same thing. You want to look for that form 1098T. That's your starting point. It is non-refundable, so it's a dollar for dollar reduction of the tax. And then your qualified education expenses, the maximum is $10,000. And so when you're talking to a taxpayer, they get all excited to go, okay, I got a $10,000 credit. You say, no, that's the expense. And those expenses are used to calculate the credit. And of course, the maximum is $2,000 for the return. So you might have mom, dad, and maybe a couple of minor kids, we'll say 19, 20 years old. And let's say all of them are going to school and no one qualifies for the American Opportunity Credit. That means The max for the return for everybody is $2,000, non-refundable. And this is an unlimited credit until Congress changes its mind. You can have a felony drug conviction. And of course, the phase out, similar to the other credit, but we don't worry about that because again, the phase out is at levels that you're not going to see at the VITA site. And then sometimes, and I've seen this before, you'll see a taxpayer show up and they'll say, hey, I've got this, I've got a simple W-2, can't you do my return? And what you want to do, you'd be pleasant with them and say, this program is not for someone making $100,000 a year. And I've seen that. I've seen people show up making $120,000 a year. I tell them, this is not for you. You need to go out in town or do your own return. And then qualified expenses, it's similar, but there are little differences. Of course, on that 1098-T, you're going to see your tuition and fees. It'll be stated along with any type of scholarships. That's the important thing about a 1098-T. And so obviously, and if you can grab a pencil and do this real quick, let's say you have someone who has tuition and fees paid to the university of $2,900. And then let's say they have some type of scholarship for $900. So you're going to take that 2,900, subtract that 900, and your qualified expenses are going to be 2,000. And so that's how that shakes out. In the software, when you make those entries, you have to do the math to determine your qualified expenses. Again, account for the scholarship. So anyway, back to qualified expenses for the lifetime learning credit, tuition and fees, and then in your publication 4012 and also in your publication 970, it says in order for you to take the course materials or add the course materials as part of qualified expenses, you have to pay the school for course-related books, supplies, and equipment. You got to pay the school. And so what that means to me, let's say I take a course at Saddleback. Let's say I take an accounting course. I need to freshen up on accounting. And so I go there and I said, I don't want to go to the bookstore. I don't want to pay anybody for the books. I'll buy a book from my buddy across the street. That's not going to be a qualifying expense because I haven't paid the school for course-related textbooks, supply, and equipment. All right, so that's a lifetime learning credit. And we'll do that at about 11. All right, any questions before we move on, Sean? I guess Sean has.
Oh, sorry, I was muted. Yeah, the question, you just answered it, Jerry. It's if you buy your books somewhere else, can you still call it a qualified expense? No.
Yeah, not for the lifetime learning credit. And these credits, again, if you're new or newer to VITA, you're going to see this a lot. And this is a big thing. So obviously the intent is to help people out and kind of give them an incentive to go to school.
So when you say not for lifetime learning, can you, for American Opportunity Tax Credit, could you buy your books somewhere else?
You sure can. For the American Opportunity Credit, you can buy books wherever you want. The school that I teach at, again, the students would say, hey, Jerry, where do I get the book? I said, well, the bookstore sells them. Well, it's too much. Okay, well, then you can go on Amazon or you can talk to a former student. There are many ways to get books. Sometimes I've actually had students contact the publisher directly and they get some discount. And of course, when we talk about books, it could be either an electronic book or a hard copy book, but again, course materials. All right. All right, Sean, let's see here. Let me see if I can unfreeze this.
Well, we are getting close to break time.
All right, then I'll tell you what, before we say break, let me go to my next slide and see if we, yeah,
right.
Okay, let's do that. This is a good time to take a 10-minute break before we jump into the child tax credit. So let's take 10 minutes.
Oh, quick question on the lifetime learning credit before we take a break. If it's lifetime learning, does the education have to be to improve job skills?
What I remember in the reading, I think it's to qualify for a job, maintain your skills, or improve your skills. I think that's the language in publication 970.
Okay.
All right. Okay, we'll take 10.
All right. See you all in 10 minutes. Hey, Jerry, your new computer setup is working great.
Yeah, I went out and got a new computer, and it's working pretty good with the exception of one class I teach at another college. My screen continues to freeze. So I'm thinking it's either my keystrokes or it's the program at the college.
Is it a Windows 11 computer?
Ooh, now you're talking to a non-computer guy. Also, I know it's silver in color. And I told the guy at the store, I want PowerPoint, I want Word, I want Excel, and access to the internet. So that's all I know.
Okay.
Watch out, it might be a Mac.
Oh, no, it's not a Mac. I know that much.
You could tell by how much you had to pay for it that it wasn't a Mac.
Yeah, years ago, a computer geek at work, I ordered a brand new computer, and she asked me what kind it was, and I said it's brown.
So you've upgraded to silver now. Huh?
No, I got silver.
For the St. Killen volunteers, Mel put a comment in the chat that we do have a few laptops available if someone needs a computer.
Hey, Sean, on the hard copy pub 4012 and the form 6744, are they at the church office?
Yeah, for the St. Killen volunteers, I have already started picking those up. We had them available on Monday.
Okay, so I can go by the office and pick one up?
Yeah.
Okay, great, thanks.
Mel, I went by there yesterday and picked up my books, and I was impressed primarily by the efficiency of your food bank operation. That looked really good.
Okay, that's a 2-minute warning on the break.
All right, great. And then Sean, can you select someone from the crowd who will be my reader?
Sure. Let's see. How about, let's see, is Marisa? Marisa, are you on the line?
Yes, I am.
How would you like to be Jerry's reader for this next
It's
piece?
okay.
Okay.
I
Okay.
think I know Marissa. Marissa, do you have a copy of the 4012?
Yes, I do. I went to the church this week and I got it. It's very top
Good.
quality this year.
Perfecto. Okay, we're going to be on page G2, as in golf 2.
Refundable child tax credit.
Yes, and then I'll ask you to read selected sections of this when we get started.
Okay, I'm ready.
Okay, great. All right, Sean, anytime you're ready.
Jerry, before you get into the next example, there is one last question on the previous tax credit.
Okay.
Came in during the break. When is the child's age determined for the tax credit?
You're talking for what credit are we talking about?
I'm not sure. I'm reading the question as it was written. Roger?
The next, I wrote it, it's for the child tax credit that we're about to talk about.
Oh, yeah.
Oh.
Well, we're going to answer your question shortly, sir.
Okay.
Okay, thanks.
All right.
All right, Sean, we ready to go?
You bet.
Okay, great. All right, welcome back. And so we're going to jump into the child tax credit. I think this is pretty exciting for individuals who have children because the credit has been expanded and it's refundable. So this is a good thing for low and moderate income families that have kids. It's a big deal. I think it's going to make a huge difference in people's lives. So I think it's a good thing. And so what we want to do, we want to give you a full appreciation for this changed or expanded credit. And so we have Marissa. So Marissa, can you go ahead and read that second paragraph that says the American Rescue Plan?
The American Rescue Plan Act, ARPA of 2021, expands the child tax credit, CTC, for tax year 2021 only. If the taxpayer or the spouse is filing jointly lived in the United States for more than half of 2021 or is a bona fide resident of Puerto Rico for 2021, the CTC remaining after applying the limitation based on modified adjusted gross income is fully refundable.
Okay, and so thank you. So that means for tax year 2021, as it says in the textbook, this expansion is for the tax year only 2021. Now, what will happen most likely in a few months? Maybe that new legislation that just recently passed the House is going to be approved and signed. If that's the case, and this particular credit may very well be expanded into future years or permanently. But right now it's for 2021. So if people ask you a question, this is the current legislation. And again, 2021 at this point. Okay, and so this expanded credit, again, it kind of changed a number of rules. So let's go ahead and go through the various items. So I'm going to have Marissa slowly read those 4 points under the expanded credit and what it means. Take it away, Marissa.
The expanded credit means the amounts of the credit for qualifying children will increase for many taxpayers. For eligible taxpayers, the credit is fully refundable, which means that taxpayers can benefit from the credit even if they don't have earned income or don't owe any income taxes.
Okay.
Taxpayers can receive the credit for qualifying children who turn age 17 rather than 16 in 2021. Eligible taxpayers may receive part of their estimated credit in 2021 before filing their 2021 tax return.
Okay, and so those are the, I guess, the new rules, if you will, for this expanded credit. And on that last item where it talks about taxpayers receiving the advanced child tax credit payments, you may have seen that, you may have heard of that, you yourself may have received those advanced payments. I got a client, one of my paying clients, who called me up and says, "Hey, I'm getting money from the IRS." I said, "Hey, that's fantastic. What kind of money are you getting?" He goes, "Well, I'm getting these advanced child tax credit payments." I said, "Okay." He says, "How's this going to be treated?" I said, "Well, it'll probably be like the recovery rebate credit, kind of similar to that. You're getting advanced credit. And so what happens is when you file your tax return, you're going to explain in the software that you've received X number of advanced credit payment dollars, and then the remaining child tax credit is going to be calculated." And then this is important. I talked to an IRS rep yesterday. I said, "Okay, in the software, how is this done? Where are the boxes in the software we're going to enter this data?" And she told me, "Jerry, stay tuned. The software is going to have something like that, but it doesn't have it right now. So you should anticipate that it's called a reconciliation, i.e. entering data regarding the advanced child tax credit payments." And then as that information comes out, what I'll do is I'll include that in one of our tax scenarios that we're going to complete. All right, back to Marissa.
Keep going.
Marissa, can you go to, on page Golf 2, can you go down to where it says qualifying child?
Yes. Number 1, under age 18 at the end of the tax year. Number 2, a U.S. citizen or U.S. national or resident alien of the United States. See tab L, resident/NR alien. Number 3, child must be claimed as your dependent. Number 4, your A, son or daughter, adopted child, stepchild, eligible foster child, or a descendant of any of them. And B, brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them. For example, your niece or nephew. Number 5, didn't provide over half of his or her own support. Number 6, lived with the taxpayer for more than half of the tax year. See exception to time lived with you section on the child tax credit chart on the following page. Number 7, must have a social security number that is valid for employment issued before the due date of the return, including extensions.
Okay, thank you, Marissa. So those are the rules for a qualifying child. And the one that I have seen in the past is issues with the social security number. So the way I read that, you got to have a social security number. And it's, I guess, about as simple as that. So someone who is an I-10 holder, that individual taxpayer identification number, that will not be a qualifying child. All right. And then Marissa, can you go to page Golf 3?
Yes. Additional child tax credit, ACTC, general eligibility. Taxpayers who cannot claim the refundable CTC because they are unable to check the boxes on Schedule 8812, indicating that they or their spouse, if married filing jointly, have a principal place of abode in the United States for more than 1/2 of 2021, or that they or their spouse, if married filing jointly, are a bona fide resident of Puerto Rico for 2021, may be eligible to claim the ACTC if they meet the following conditions. Taxpayers with more than $2,500 of taxable earned income may be eligible for the additional child tax credit if they have at least one qualifying child. Taxpayers with 3 or more children may also be eligible for additional child tax credit regardless of their income, and limited to $1,400 per qualifying child.
Okay, thank you, Marissa. And so I think what will happen when you start preparing returns, again, all of this, when you enter it into the software, it's going to be computed for you. Yes, you do have to ask those questions about the Social Security number. We do that anyway, And I know at St. Killian, we actually secure a photocopy of the Social Security number. So that's important. So this is something, again, it's a big deal. It's a big change for a lot of individuals that have children, and it's more money in their pocket. So I think it's a good thing. I think it's a good thing, certainly for the taxpayers.
Hey, Jerry, there's a question. For these advanced childcare payments, does the IRS send the taxpayer an information notice about how many advanced payments they got? Or are they just supposed to have more record keeping where they keep track of this on their own?
Yeah, I'm going to plead ignorance on that. I do not know. It might be like the EIP that we have, the economic stimulus, where there's some type of document that's sent out to the taxpayer. Dear taxpayer, you've received these advanced child tax payments. Take this to your tax person. That's probably the expectation. But again, more to come. I'm looking at this on a regular basis. I've got my feelers out to people that I know in the tax world. And once I get some type of information, I'm going to share it with the group here on one of our calls.
And then there's another question just rolled in. In case of an overpayment of advanced child tax credit, is there any repayment protection clause to protect taxpayers?
The short answer is yes, and I'm not sure exactly what it's called. I was reading about that, and yes, there's some type of protection, and it does apply to certain individuals. And again, once I get the more detailed information, I'm going to share. Excuse me, I want to share that with the group.
Okay, thanks. That's it for the questions.
Okay, all right, then we're going to go to our next slide, which I believe we're going to be talking about our tax return. And we're going to spend a little time on this. Oh, I stand corrected. So this is the next slide talking about the credit for other dependents. You might remember this. This came out with that Tax Cuts and Jobs Act of 2017. And if you go to page Golf 6 in your publication 4012, you'll see the other dependent. This is at the $500 credit. And if you go to page Golf 6, it talks about this particular credit is available for those who do not qualify for the child tax credit. And of course, you must have what is called a valid, some type of valid identification number. That could be a Social Security number or an ITIN, individual taxpayer identification number, or an ATIN, adoption taxpayer identification number. And so this is something for young adults. Again, it's that non-refundable credit, $500. And it'll be computed automatically in the software. But again, if you have an ITIN holder, here's an opportunity for them to, if they meet all the requirements, to obtain that $500 non-refundable credit. All right, so what we're going to do now, we're going to jump into the Jean, I think her last name is pronounced Arista return. And then we're going to talk about a number of things to include the child and dependent care expense credit, child tax credit, and American Opportunity Credit. And I'm wondering, Sean, are you able to bring up the practice lab so we can go ahead and go through it step by step?
Jerry, do you want me to stop sharing your screen and bring up a practice lab?
Yeah, what I'm going to do, but before that, I want to show the tax scenario, have a couple comments, and then when you're ready to go, we'll go ahead and you'll bring up the tax, the practice lab, and we'll run through it. But let me go ahead and bring up the scenario first. All right. Okay, and I have made, I think in football, they call it an audible. And so let's see if you can see this. Sean, can you see my screen?
I see the practice return on your screen, Jerry.
Okay, great, thank you. Okay, so what we'll do, let's run through this. I'm gonna ask a few questions and then we'll go ahead and jump into the preparation. So I did make a change here. I don't think it makes a difference as far as the refund, but I would like you to go ahead and, because I modify this, I want you to go ahead and for Jean, she's a qualifying widow with dependent child. I threw in a dead husband in the equation. So go ahead and change the filing status to qualifying widow with dependent child. Okay, so we're going to go through this. So we have Jean. She's a resident of California, and she has a W-2 job, and she has wages of $45,000, and then she has withholding both state and federal, and she pays into the state disability insurance program. And then she also has health insurance through the employer. And you might remember when you're entering data into the software, there's a couple of boxes we typically use. We use box 12 and box 14. And in box 12, usually we have code D as in Delta, which is deferred compensation, and then code Delta Delta, which is insurance paid by the employer on behalf of the employee. So she's got coverage. She's got some interest income. And you might remember from last week, somebody asked about the information you have to put into the software regarding the 1099 INT. And what I know is, yeah, you have to put in the bank, you got to put in the EIN, employer identification number, the address, the whole thing. Okay, so again, she's got interest income of $80. She's got dividend income of $10, ordinary dividends. And we've mentioned this before. You might be familiar with what is called a dividend reinvestment plan, commonly called a DRIP. And so if someone, like for example, I've got a dividend reinvestment plan for a couple of companies where I own stock in. And so I tell them, I don't want a check. I don't want $5 to be direct deposited to my account. I want you to take those dividends that you guys pay me and just buy more shares. And that's called the dividend reinvestment plan. And what that means is that's constructive receipt of income, even though you didn't get the check in your hot little hands, you could have. And so again, that's called constructive receipt, which means it's a fully taxable event when those dividends are essentially paid out.
So Jerry, I've got the practice lab already up. Whenever you want me to share a screen, just let me know.
Okay, sounds good. And so prize income, you see this, I actually see this a lot. And we mentioned this before. I am seeing more and more individuals winning these small prizes. And then sometimes they'll say, Jerry, I didn't get a W-2 or a 1099. And I tell them, okay, well, that happens from time to time. And what I do is I go back to Internal Revenue Code section 61, which says everything's considered gross income unless otherwise excluded. And there are only certain prizes that are excluded. And for VITA purposes, if someone says, I want a prize, it's going to be taxable. Okay, and this particular taxpayer has a daughter, a minor child, approximately 5-6 years old. And the taxpayer drops off the daughter at a care facility. And of course, while the taxpayer is at work. And so this is part of that child independent care expense credit. And you'll see that she paid a total of $2,400 for the year. Okay, so we got a daughter, and then we also have a son. And you'll see that the son, he's about 20 and change, and he goes to school. Now, this is important. If you don't have a copy of this document, we'll spend a little time here. You might want to make a note or two so you can stay with us. So we've got the dependent son, and he goes to college, and this is one of those qualified universities. And this is his first year in college, and he hasn't claimed the American Opportunity Credit. And so this is the credit that we're going to go ahead and apply for, if you will. He doesn't have any felony convictions. And we talked about that 1098T as in Tango. That's that information return that reports the amount of tuition and fees paid to the university. And it also reports the amount of scholarships that the student has received. And so that's something you want to look for in the 1098T. And then in this scenario, it says he paid $400 out of pocket for his college textbooks. That amount is not going to be reflected on the 1098T. In fact, for that matter, I don't think I've ever seen textbooks reflected on the 1098T. There's a parking pass. And we mentioned before that parking pass, and someone would make an argument, hey, if I park on the campus and I don't have a parking pass, I'm going to get towed. And I would say, yeah, that's factually correct, but here's the deal. That's not part of those qualified expenses. And then the cafeteria pass, cafeteria, that's the place where you go, and most people know it's, get lunch, something like that. And some students pay for a pass, whether it be semester or for the year. That is not part of qualifying expenses. Ernestine already said room and board, it's not part of qualifying expenses, so that's not allowed. So this is the information from the 1098T as in Tango, and I'll direct your attention to box 1. That's the amount that's paid to the college by the student, or it could be the parent. But again, that's the tuition that's paid to the school. And box 5 shows the scholarship.
Jerry, what about the student fee? A lot of times there's a student fee with a university.
Yeah, if you have a student, that's why they call them tuition fees. So if you have a student fee, not a health fee, but a student fee, that's part of tuition fees, correct?
Okay.
And so again, what you want to do for this scenario, and Sean and I will go through it, you want to determine what are called the qualified education expenses. And in this scenario, in order to determine that, you're going to take box 1, subtract box 5, because that $4,500, it was paid, but there's a scholarship. And so you subtract $2,000 from $4,500, you end up with $2,500 out of pocket for tuition, $2,500. And then you're going to add that $400 for textbooks. And then you'd be up to $2,900. And so that's how that works. All right. And then a couple other things. I didn't receive one of these. I've talked to people who have the third federal stimulus payment, and Jean did not receive the third federal stimulus payment. And as I mentioned before, I had a couple of taxpayers, they got confused about the payments. And so I said, okay, let's go ahead and bifurcate it. Let's talk about federal government only, and then your state government, California, that's a different animal. And your state stimulus payments do not appear on a federal tax return, nor do they appear on the California Form 540. Okay, so here's something that you're going to see. Thomas, who was Jean's husband, he passed away in December 2020. So we're looking at a tax year 2021 return. And then what happened is he had insurance, life insurance, and what happened is there was a payment made to his surviving spouse in calendar year 2021. And so I've seen this a lot. And when you have an insurance program like this or payout, there's no tax consequence, none whatsoever. So what happened is Jean and or her husband, they were paying premiums on this policy. Thomas passes away. The surviving spouse gets a check. Again, no tax consequence. And a lot of times in the VITA program, someone will receive an inheritance. And the general rule on inheritance, as the recipient, there's no tax consequence. Now, of course, if you inherit a home and then you turn it into a rental, then you have to report the rental income. If you inherit a 401k that's all tax deferred, well, then someone's got to pay the tax, and that will be you. Okay, bank account. I've seen this in VITA a lot, where someone will have more in their bank account than I've got in my bank account. And we don't base qualification on net worth, we base it on income. So in this case, she still has some of her insurance payout in her bank account. And then this is something that we're going to address on our last training session, where you have individuals receive their state refund. And then what happens, they ask you, is this state refund going to be included in my federal tax return? And the answer is, if you took a tax benefit, i.e. you itemized on the previous federal return on that Schedule A and took the full tax benefit, then any type of California state refund on your current federal return is going to be a fully taxable event. And we're going to show you how that works. And you may have seen that before. And I remember looking at a report a couple of years ago, and I think this is not the same. About 10% of VITA clients itemize. And so the short answer is most people are going to take the standard deduction, so you're not going to be concerned about that state tax refund. But if they itemize, and again, we're looking at the tax year 2021 here, if they itemize in 2020, that's when you want to say, okay, tell me about your state refund. Did you take that benefit?
Hey, real
And
quick.
then in tax year 2021, the rules have changed a little bit when you're talking about contributions. So if Jean does not itemize, she still is going to be able to take that above the line charitable deduction, which we're going to see. And of course, that's limited to $300 for a single person. For a married couple, it's going to be $600. And we know that St. Killian is a qualified charitable organization. If there's any doubt about someone donating to a qualified charitable organization, you can do a number of things. You can ask for a tax identification number. You can go to the IRS website and you can drill down to all of the qualified charitable organizations in the United States. And there's a whole bunch of them. And then Gene paid dues to an association. We do have people who pay dues. And we do know that dues used to be deductible on the Schedule A. They are no longer deductible on the Schedule A. That went away with the Tax Cuts and Jobs Act of 2017. And then, of course, if you have someone who's paying professional fees and they're self-employed, that's a different animal. If it's an ordinary necessary expense, then they may be able to take a deduction on their Schedule C. Okay, there's a check figure. I did this last night, so hopefully my check figure is going to be the same as Sean. And so Sean, at this point, I'm going to hesitate and see if anybody has any questions, and then we'll jump into the tax preparation.
There was one question regarding the life insurance payment. If that was a whole life policy and there was earnings on the life insurance, would the earnings be taxable?
Yeah, I'm doing this from memory. I haven't tackled that in a long time, but yeah, when you use the term earnings, that tells me that you probably have a tax consequence. What I'll do though, I will go ahead and jot down whole life. And when we come back on December 4th, I'll have a mini presentation on whole life insurance payout.
And then you mentioned the $300 and $600 for the cash. But I believe they raised that to $500 this year, but we'll see when we plug it in.
Yeah, what I remember for a single individual, and again, I did this last night. I think it was 300, but we'll find out. We'll find out. And here's another thing: when you're talking about whole life insurance, I'm not an expert at whole life insurance, but there's different terms that describe whole life insurance. So with whole life, you have what is called a savings component. And so with term life insurance, like I used to have term life, I'd pay, I don't know, 30, 40 bucks a month. I had a policy for 400,000. There was no cash value. So if I died, and what happened is that $400,000 term life policy payout would go to my wife. But with whole life, or sometimes they call it universal life, there's other names for it. You've got a savings component, which means you have cash value. Okay.
There was one other question on the dues. Are those deductible on California returns? I know we're not going to cover that until next time.
And doing this from memory, the short answer is yes, I believe it is, but we will address that when we do the California one.
Okay.
All right. At this point, we're going to ask Sean to bring up the software. And if you're new or newer, we'll take our time going through the entry here.
All right. Hopefully
Okay.
everybody can see this now.
Are you able to make that full screen and go real slow?
How's that look?
That looks pretty good. And so we just want to confirm, once you enter the Social Security number, we want to confirm we're in tax year 2021.
Yeah, it should be because I chose for tax year 2021, but
Okay.
we shall see.
All right. And then what you're gonna see here is you're gonna see in the upper right hand. Okay, we'll answer that. Yeah, and this is where it says the IRS is working on it, and I know it takes time, but they're updating it. And here's something that I've seen about 4 or 5 times. You will be working with the practice lab, and you're going to get an incorrect number, and you're going to shake your head and say, "How can that be?" And the answer is, I don't know, but I do know that happens. And so when you see it, you should be aware of that. But with the real software, obviously, tens of thousands, hundreds of thousands of people use it. And so the real software is typically spot on. Okay, we're going to go and answer this. So before we hit continue, again, just very quickly, in the VITA program, your biggest challenges are most likely going to be your head of household. That's probably going to be your biggest challenge. And when you see the head of household, you have to qualify, which means you are either unmarried or for tax purposes, you're considered unmarried. And when people say, what do you mean by tax purposes? The answer is it's very simple. Congress, i.e. the House of Representatives and the Senate, they come up with legislation, the president signs it, and then you have tax law. And so this tax law or tax provision. So anyway, that's the most challenging one you're going to see. Qualifying widower, again, when someone passes away in tax year 2021, what happens is they can file married filing. We're talking VITA now, married filing joint for that decedent. If you're talking about tax practitioners, you have different answers there, but for our purpose, you're talking about married filing joint in the year of death. Okay, in this case, she's a qualifying widower. Her husband died in 2020, and this is now 2021. So in 2020, tax year 2020, she would have filed married filing joint. In tax year 2021, she's filing qualifying widower. Okay, next. And then you're going to indicate the year of death. It was 2020. And then let's see here. Oh, here we go. If you go to the upper left-hand corner, you'll see in light gray, a little bit over to the right, Sean, you'll see the tax year. And I don't know about you, but this has goofed me up a couple times. So when you're starting a return, you want to make sure you've indicated the correct tax year. And we did have an IRS meeting the other day, and I think, Mel, you were on that call for our VITA program. You can actually prepare returns going back a number of years. That software that will come out here shortly, we can go back a number of years, but you can only e-file, I think, the last 3 years. Okay, so Sean's making the entries regarding the date of birth. And her occupation, she's an administrative assistant. And then we're not going to indicate any of these boxes here. Probably when you start working on returns, that contribution to the presidential election campaign fund, you may indicate that if the taxpayer says, I want it. And then you can go to, Sean, you can go to that one just a little bit above the address where it says, if you want to elect to use your 2019 earned income. And so what that means is that's going to be in effect for the federal return. So you got to get that data for 2019. Most likely it's going to be in the archives of our program. All right. And Sean is continuing to populate this. I'll call out stuff as I see it. And then what I try to do, and I'm sure a lot of people do, I try to get, if it's a joint filed return, I try to get both the husband and the wife's phone number, because sometimes someone's at work and can't answer if you have a follow-up question. We do have dependents, so we'll indicate that. And our first dependent is going to be Fiona, Fiona. And her last name auto-populates. She was born July 5th, 2015. And then her social is 400-00-5652. And then chances are in the VITA program where it says check here, if the individual does not have an SSN, ITIN, or ATIN, you're probably not going to have that, because most of the taxpayers come to the site, they've been fairly well educated regarding their ID number. So they're either going to have an ITIN letter. In fact, I don't think I've ever actually seen an ITIN card. I think it's a letter that they usually present. And yes, this young lady, this girl is a US citizen. And she's the daughter, lived in the house for 12 months. And there's a note there. It says, If this dependent was born in 2021, you must select 12 months. And that's something you're going to see from time to time. A child will be born in the tax year that you're working with. And this is where it comes into play. And then keep in mind, I may have mentioned this before, for the earned income tax credit, if a baby is born and it's a live birth, and then subsequently that baby passes away in the same tax year, the taxpayer is still eligible if they qualify for the earned income tax credit. I had a real tragic case where the parents had a baby. The baby survived for about 5 minutes. And the guy asked me, well, what do I do as far as earned income tax credit? I said, well, you're going to be able to get that. You will be able to get that. Okay, so she's a kid. She's not going to school. And so we're going to hit continue. Then we're going to add another dependent, and this will be Ernest, the son. And he was born on May 3rd of 2000. And his social is 400-005558. And he is a US citizen, so we'll indicate that. And he is the son. He lives in the home. And then Sean is going to click that top box. This person was over 18 and a full-time student, because he's going to that college that we indicated. So we'll hit continue.
Daughter, he checked daughter, not son.
Let's see. Let's see that quality control. Good catch.
Sorry.
Mel, give that gentleman a raise. Okay.
That's gonna
And
print
now
out on the part about $4,300. We had one taxpayer last year who had a dependent who earned $4,310, and it made a big impact on her taxes.
Yeah, that's why you ask if they've got kids. Do the kids work? And if the kids work, and let's hesitate for a moment. So if you have a child who's engaged in self-employment, or they're a W-2 wage earner, well, typically W-2 wage earner, I think the labor laws, I think they have to be 14, but you might have a kid, i.e. under 18 years of age, who's self-employed or a wage earner. If that's the case, they're going to file their own return. You cannot assign self-employment. You cannot assign W-2 wages to mom and dad. That violates the tax doctrine. Okay, continue. And nothing here, so we'll go past this.
If the person did die that year, would we normally have to upload a death certificate?
What I remember, you have to fill out that 3010, and let's see, do you upload the death certificate? I've never done that. Let me ask the participants. Does anybody have any experience with uploading a death certificate for a decedent?
I had to fill out a form for a decedent, but I never submitted a death certificate.
Yeah,
I think VITA policy is you don't attach documents, and if the IRS wants it, they'll ask for it. You should advise the taxpayer that might get a letter from the IRS.
That's a good point. That's a good point. I did a return for one of my paying clients. I helped out him with the return. His sister passed away, and I don't recall uploading anything, but I did indicate on the 1310 that we had a decedent. All right, thanks. Okay, next. And then what we're going to do here, we're going to hesitate for just a moment before you hit continue. Just a reminder, you do have taxpayers who get that identity protection personal identification number called an IPPIN. And if that's the case, if they get that letter from the IRS, it allows them to electronically file. And so that's why people will get that IPPIN. And I've seen that from time to time, probably about a half a dozen times at the VITA site. Okay, what we're going to do now, we're going to hit that recovery rebate credit. And we're talking about the third round of the economic impact payment, the stimulus payment. We're talking federal. And in this particular case, Jean did not receive the payment. So we're going to indicate she did not receive the payment. I don't think you clicked on that. So can you go
Oh,
back?
the box actually said I did receive it.
What box?
I'll go back.
Yeah, I think you
Where
have
is
to go
it
to,
now?
I think you have to go to federal section or basic information, start with basic information.
I think it's in basic information.
Yeah, go to basic and then we'll just start all over. There you go. So we'll click on a recovery rebate. And
See,
we'll
it says I
indicate-
received, so I did not click that because she didn't receive it.
Yeah, so you click that lower one that says, I have not received any stimulus payments.
Oh, but she received round 1 and 2. That's why I was confused.
Yeah, so we'll just indicate no.
All right.
But round 3 refers to the $1,400 per capita they got early in the year, correct?
Right.
Yeah, round 3. I can't remember when round 3 came out. Alls I know it was advertised and people were very happy, the ones who got the check.
It's just
Okay.
confusing the way the question stated because it says I didn't receive any, but I mean, obviously she received round 1 and 2 in the previous year. So
Yeah, we're just talking about round 3. Okay, so let's go to the W-2. And again, as I said, this is the most common form. You're going to see this a lot in the VITA program. And we're going to indicate that Jean works at this shop. And so we're going to put in the EIN, which stands for the employer identification number. And that's 95 87 65 433. And if it auto-populates, fantastic. And then Sean, humor me. Let's say the name of the employer is called the T-Shirt Show. Remove the letter P as in Papa. There you go. And so if you need to make changes to the software, you just go ahead and make your change. But again, the mantra is we're going to key the software as we see it on the W-2. That's the mantra. Okay, we're going to go down and she has $45,000 of income. And she has tax withheld of $1,500. And then the auto population in 3, 4, 5, and 6, typically you're not going to make any changes. But if you have to, all you got to do is just go to that box and make the change. And then what, just to kind of, because sometimes people look at this and say, what is this this tax I'm paying? Well, Social Security tax is 6.2% and Medicare tax is 1.45%. Okay, let's cursor down to box 12. In box 12, again, the letters that you're going to use typically in the VITA program, it'll be D or DD, Delta Delta. In this case, she's got health insurance paid by the employer, and that's $4,200. And let's see if she's got a retirement plan. I don't think that's part of the scenario. But if she did have what's that?
it's not stated.
Yeah. So if she did have a retirement plan, then we would indicate that. We'd click that box. Yeah, we'll key it as we see it. And then in box 14, we're going to indicate she pays state disability, and that's $250. And just a reminder, when you're working with people who have received state disability payments, and that could be an expectant mother who's been told by the doctor, hey, you need to take off work. You want to make sure you have a healthy baby and you want to be healthy. And so they go on disability payments. Those disability payments are non-taxable, both federal and state. They pay the premium, so it's non-taxable. And that's the general rule for disability. Okay, we go to the state information. And as a reminder, we only do the California return. And the state EIN auto-populate, looks good. And then back to box 16, you're typically going to have the same dollar amount on box 16 that you're going to have on box 1. But you should keep in mind certain taxpayers, they will have either no amount in box 16 because their California wages are not subject to California taxation. That does happen from time to time. I think the example I gave you when I was living in Cuba, I had to pay federal income tax and I did not pay any California state income tax. Okay, box 17, state tax paid. That would be state tax withheld to the tune of $400. And then 18, 19, and 20, we talked about this before. There are no jurisdictions in the state of California other than the Franchise Tax Board, if you will, that has an individual income tax. You'll see an individual income tax in New York City, Lansing, Michigan, and some other places. All right, if you want to add a W-2, you would go to the upper left-hand corner and you click Add W-2, but we only have just the one. And then let's see here. We've got some interest income, so we are going to go to the 1099 INT. And then Sean's going to indicate interest. And then here you go. And then typically what will happen, Chase Bank, typically what will happen is the individual will have a 1099 INT. And if they don't, then you're going to ask them how much interest did you receive from your bank. All right, he's populating that.
Oh, they don't all go in. You put too many numbers.
Too many numbers, 1, 2, 3, 4, 5, 6.
Oh, I got an extra one, sorry.
Okay. And then put in the old street address, which is 5140. Yeah. And this is a question to the participants on the call. Does anybody have an account at a credit union?
Yes, I do.
And what do they call the monies that are paid to you for the monies that you have in deposit? They still call it dividends, or they call it interest?
They call it dividends, but I report it as interest.
Okay, very good. Yeah, so for a credit union, you report the income that you receive for monies on deposit as interest. Okay, and so now we're going to go to interest income. She has received $80, 80, and that would be in box 1. So Sean, go to box 1 and enter 80. Okay, that's all we have for this particular taxpayer. And we're going to go ahead and hit continue. We'll go to dividend income. A couple ways to get to it. Good job. And then as he's filling out the dividend income, what you may see on a 1099 DIV, you may see the foreign tax credit reflected, and you may see what are called capital gains distributions. So you want to key it as you see it on the 1099 DIV. And the total on that was $10 ordinary. Okay. And then sometimes you may have federal tax withheld. Again, it'll be indicated on the 1099 INT or DIV, and you want to go ahead and enter that data into the software. Okay, we are done with this portion. We're going to hit continue. And then hit continue. And then Sean, I think this might be a good point where we can take a couple questions, take a break, and come back and tackle the child independent care expense credit.
Yeah, I'm not seeing questions. There are some like clarifying comments. There was discussion about the third year or the third round rebates, whether we might have included them last year and we didn't. Somebody's asking questions about prize winnings. We're going to cover that right after the break.
Prize winnings, as I mentioned before, for our purposes, prizes are going to be a taxable event. There are certain prizes that are not, but for our purposes, that they will be included as a taxable item.
And then Adela noted that sometimes a W-2 for California will show the state disability in a local taxes box, but we have to put that in box 14 and use the drop down for state disability insurance.
Yeah, that's a good point, because box 18, 19, and 20, we don't use it in California. If you're a VITA worker in New York State, then you would, i.e. New York City. Okay, any other questions? Otherwise, we'll take that 10.
Oh, that's it. Let's take a 10-minute
Okay.
break.
All right, we'll come back at 11.
All right, everybody, 2-minute warning on the break.
Okay. And then Sean, if you could, let's start with this page. I just had a couple comments when we get started.
We did have one question come in over the break, Jerry. With regard to that dividend payment, was that a qualified dividend or a non-qualified?
That was an ordinary dividend, which is
Or-
taxed at ordinary income rates.
Okay. Okay, it's 11 o'clock.
Okay, just a couple comments before we continue with our entries for Gene, our taxpayer. In tax year 2021, if you receive unemployment compensation, you're going to get that form 1099 G as in golf. However, in 2021, for federal tax purposes, unemployment compensation is going to be taxed the entire amount if you remember last year, there was for most people, there was a $10,200 exclusion that no longer exists for tax year 2021. And then, Sean, if you can go down to the tab that says alimony. And I've actually seen this a little bit more often now in the VITA program. When you're talking about alimony for people who got divorced after 2018, what that means is the alimony that they receive is not going to be included in taxable income on their federal return. And if someone is paying alimony for a divorce that occurred after 2018, they're not going to be able to take a deduction. Now, for the state of California does not conform. And so if you're receiving alimony, it's going to be an item that you have to include on your California return. And we're going to go through California on December 11th. We're going to spend some time getting in there and doing what are called additions and subtractions to the California return. And again, the term is conformity or non-conformity. And so an example is conformity. If you have W-2 wages, let's say you're working for, let's say Starbucks in Mission Viejo, and you make $30,000, California conforms, which means you're going to report that income on your state return, that $30,000. And nonconformity, again, would be the alimony example that I gave you. All right, let's go to less common income and let's put in this cash prize. Other income not reported. Maybe that top tab. And so you're going to use this, you might use this for a situation where someone receives a court settlement, or in this case, they got a prize. Now, if you have a court settlement, it's going to beg lots of questions, and they'll probably beg the question, what's the precise nature of the settlement? And do you have the instrument? Do you have the documents as issued by the judge, the settlement, if you will? Because sometimes you're going to look at a court document and it'll show you items that are taxable. It'll show you items that are not taxable, for example, medical reimbursement expenses, and then items that may be taxable in part. So if you get that, you just want to scrutinize the document, ask the questions. So in this case, cash prize, and the amount was $150. And then, of course, and I think this happened to me one time, someone offered me a prize and I said, not interested. It's too much of a hassle to go down to the mall. So you guys keep it. If you refuse a prize, you do not have actual or constructive receipt of income, so you don't have to report it. Okay, we'll hit continue. And then if you had an additional item, then you go to where it says add another one. Okay, so now we're going to go to our deductions. And we're going to go to our credit menus. And of course, a lot of these credits that you see, sometimes you're going to work with one or multiple ones. Okay, let's see if we can navigate through this one. So we're going to start off with step one. And we have a kid care. And he's putting in the EIN. And so once again, if you're working with someone who has an individual watching their child, then you're going to attempt to secure that SSN. And in the language in the publication, it talks about a bona fide attempt. And so that means you're going to ask them and you're going to tell them why you want their information. And that would be a bona fide attempt. Okay, he's putting in the name of the and address of the daycare provider. Hey, I'll throw this question out at Mel. Mel, does St. Killian's have a daycare program?
I don't think we do. A lot of places have like a mothers or preschoolers or something like that.
Okay.
I don't think we do.
Sorry, Jerry, I'm on mute. Yeah, we don't have any daycare program.
Okay. All right, so then we put that information in, we cursor down to the bottom, And let's see, it's asking about the amount paid, in this case, $2,400. And then it says you have to provide a phone number. And I would think if you're dropping your kid off with someone, you definitely want their phone number and vice versa.
Yeah, now we had a question, Jerry. This is kind of a basic question, but I don't think we've covered it yet this year. What is the income limit for the volunteer income tax assistance?
That limit is written in Jello, not in concrete. And so the last number that I saw was 66,000. And then what happens is you might have a return that's a little bit more complex. And you might have a very simple one. So for example, someone comes to the VITA site, they got a W-2 and that's all they got. And their W-2 is $68,000 or $70,000. Then you might end up, of course, it's all up to the site coordinator. You might end up allowing that. But if a guy comes in with 100,000, 120, well beyond the guideline of 66,000. And so again, you be nice to them. You just say, hey, this is not for individuals such as yourself. You should go out in town. And I'll mention this, and I'm not plugging any particular type of practitioner. There are many different types, but you can go on the IRS website. You can find enrolled agent names and numbers. You can go on the California Society of Tax Consultants, and you can find an EA or a CPA or an attorney in your area to help you out. So there's all sorts of ways, or you can go to one of the commercial preparers. So yeah, you want to do that, but don't, and we all know this, but just kind of reminder, do not recommend a particular preparer. Like I'm a paid practitioner and people ask me, hey, can I get your card? I said, no, I'm not going to share my card with you. I'm not trolling for business.
What about recommending software programs? Are we even allowed to do that?
I guess the short answer is, since there's so many different types, I would just tell people if you want to self-prepare, then you can go down to just about any big box store and they've got software preparation packages, and there's different types. I've never seen a bad one. I've seen ones that are not user-friendly, but at the end of the day, they're all going to compute the amount of the refund or the tax. So I don't know if I would invoke a name, but I would just say, hey, just go buy one. They're commercially available. And then most people, they're going to say, what about TurboTax? I'm thinking, well, that's one of them. And you're going to get to the right answer after you enter correct data. So I would just say, go get one. There's all sorts of ones. Okay, dependent. And this would be for Fiona. Fiona's 5 or 6 years old. And then just a reminder that they red garbage can, and this may happen from time to time, your entry is so garbled, you just want it all to go away and start over. And so that red garbage can, you click on that and you will delete all of your data that you've entered for that particular section. The blue pencil is revisions. All right, let's see, qualified person, click on that.
Just real quick, there's a question from Bill in the chat. He wants to know if you're aware of any software that's very similar to the tax layer.
I have to plead ignorance because the only software I've used TaxWise, I've used Drake, and I've used TaxSlayer. And TaxSlayer, that's what we use in the VITA program. I think it's user friendly. I'm used to it, but those are the only ones I've used. And the last time I looked, I remember going to a convention one time, and there must have been about 20 different software companies out there, small and big. So. But if you're doing your individual return, I would think you'd probably want to expend a modest amount of money and not spend a whole bunch of money for a program if you're just doing the one return.
Yeah,
So,
I know I've used and I've recommended to some other people a program called taxact.com, which is, you can access it through the IRS site. It's free for low income taxpayers and it's very user friendly.
yeah, and I would just mention this. I mean, I think we all can agree at some time that when you prepare returns, sometimes it's real easy and sometimes it's not easy. And so if you have someone who's not trained and they're using software, sometimes they're going to make entries that are incorrect, which will result in incorrect returns. So what you want to do, you want to have a modest amount of knowledge. You want to make sure you're making those correct entries. And sometimes you might have to get a book or confer with someone, or if you're low income and moderate income, again, the program at St. Killian, you've got a lot of fantastic preparers. You got a lot of good people. So I would invite them to come over to the church and help them out. Okay, I think we're at number 3, the qualifying person, which means I think we've got that. So we go to page 2. Let's see if we've done everything we need to do.
Oh, we didn't do something on costs.
Yeah, and I was playing around with this last night for some strange reason. I hit continue. Okay, let's do this. There's no additional income. And very bottom, did you pay any expenses for 2020 during 2021? The answer is no. And are you considered unmarried? The answer is yes. And let's see if that does it.
Jerry, I'm sorry. This is Arnie. There,
Yeah.
I do have a question on this on additional income. So that's not the additional income that the person might have earned by having a child care provider. And
Say that again. You mean additional
Okay.
income from what
yeah,
source?
so this is on step 2 on the previous page that we were at. Let me see. On page 2 of F2441. This form here, but on page 2.
All right, I'll go back.
Let's see if we can solve this.
Don, you just have to add $2,400 under Fiona's name. Yeah, there you go, the
Yeah.
pencil, and then
Yeah, yeah.
qualifying expense, yeah,
Thank
and
you,
it'll go away.
thank you.
There you go.
There you go. 2,400. Thank you.
Oh, I was talking about something different, but
Yeah, I know. It was you're talking about in the additional income, which comes up
yes,
next. Right there.
yes. What is that?
All right, so if you read step 1 and step 2, in fact, we'll do that now. Who asked the question?
Arnie.
Arnie?
Yes.
Arnie, can you read step 1 aloud?
Yes. Step 1: figure out how many months you were a student or disabled and did not work. Do not include any months in which both you or your spouse, if applicable, or both students. Oh.
Okay, and what about step 2?
Step 2: if you have just one qualifying child that you paid expenses for, multiply the number of months you figure in step 1 by 250. If you have more than one qualifying child, multiply the number of months by 500. The result is what you should report in additional income as a taxpayer.
So what you're going to see, you may see this from time to time where someone's going to school and of course they drop their kids off for daycare. So this is that plug figure that we talked about. And so again, in the interview process, if they say, yeah, I've got expenses that I pay for childcare. Okay, so what are you doing? Are you going to school? Are you working? Are you looking for work? And that's important. I had one taxpayer who I think she went to some type of, I think she called it a tea party and dropped off her kid. I said, well, if you're going to a tea party, that's not working. That's not looking for work. That's not going to school. And so that's not an expense you can claim for the purposes of this credit. All right. Let's go to continue. Yeah, what else do we have here? Okay.
I think we're done with that.
We're going to go to the 1098T. This would be the education credit. And this is for the son. So if you go to the top, you gotta change the kid. Okay, and this is the American Opportunity Credit. And before we enter any data, let's see if we get some a volunteer. Scott, can you call out someone? I'm going to ask a softball question.
I'm confused. You asked me.
Oh, he's doing that thing again where he calls me Scott.
Oh, did I
Okay.
call you Scott?
Yeah, which confused Scott a lot.
It's confused me too.
Sean, I apologize. You are Sean.
Right.
Sean, can you call someone out?
How about I'll call out Natalie.
Natalie, okay.
Are you there, Natalie?
Yes, I am here. I had to unmute
Okay.
myself.
Natalie, had a question regarding the qualified expenses for the purposes of the American Opportunity Credit. Generally, how would you calculate the qualified expenses?
I would look at the Form 1098T, and so I would look at what the tuition expenses were, and that's reported in box 1. And then I would look to see if there's any scholarships and or even Pell Grants, and that is usually reported in box 5. So then I would take the difference between the two. So I would get the tuition of $4,500 less the scholarship. And then the balance would be what you would report on the tax return.
Okay, and then Natalie, once you go through that calculation, what kind of follow-up question would you ask the taxpayer regarding their education expenses?
Regarding their education expenses, well, I'm assuming that, I mean, it's reported on the 1098T. So those are most of the expenses. But the other thing that I like to do is I like to request that the student print a year-end student statement. And that's where I can catch a few other expenses that might not be on the Form 1098T.
Okay, and that's a good point. And so typically what you're going to see, you're going to have someone who will be purchasing books. That's the typical, hold on a second, Sean.
Yeah.
So that's typically what you're going to see. So in this particular case, you are correct. You take the $4,500, that's the amount paid for tuition and fees. You subtract that scholarship amount, which is $2,000, you end up with $2,500. And then according to the word problem that we have to add that $400 for out-of-pocket textbooks. And so now we're up to $2,900 for qualified expenses. And the term that I like to use the term because I think most people understand when you say, what are your out-of-pocket expenses? What did you pull out? How much money did you pull out of your pocket to actually pay for tuition and books and fees? And so, yeah, that's what you would do. So in this case, it's $2,900. And then we're going to go and populate the information for the 1099. I stand corrected, 1098T. And then the next question says, did the student receive this from this school? The answer would be yes. And again, I've had a couple situations where people say, Jerry, I can't get the 1098T. And I tell them, okay, I understand that, but go back to the school, talk to someone at the school, and they'll be able to generate a 1098T for you. Okay, the next question is, did you get one for 2020? No, because this young man did not go to college in 2020. We're going to enter the EIN. And in that case, it's 37700-1234. And then down here, now this may confuse someone who's new or newer to VITA. There used to be a credit called the Hope Scholarship Credit. And that name now has gone away. It's now the American Opportunity Credit. But you might have someone who went to school a number of years ago, i.e. college, under the Hope Scholarship Credit. And now they're back in school and they want to apply for the American Opportunity Credit. So again, the rule is you can claim this for 4 years. And that's why the question is, has the Hope or American Opportunity Credit been claimed? The answer is no. This individual, this is his first year. And their half time that will be right from the 1098T as in Tango. And then the next question, it talks about, did they complete 4 years of post-secondary education, i.e. college? That would be no. Was the student convicted? The answer is no. And then Sean, if you just hesitate for a moment, if you could take your cursor and can you circle that answer above that says, did the student complete the first 4 years of post-secondary education? And so if you get into the publication 4012, in some circumstances, and you gotta follow the chart in 4012, you might have a first-year graduate student that actually qualifies for the American Opportunity Credit, but typically it's going to be for our what we call our 4-year students, first, second, and third and fourth year. Okay, let's go down.
We saw
What's
some
that?
guys last year at our site who went to community college for the 2-year. And so they saved knowing that they'd have much higher expenses in graduate school. So they didn't use the American Opportunity Credit in their first 2 years.
Yeah, that's tax planning. Yeah, that could be a good thing. Okay, we're going to go to that last question. And I remember the first time I read this a few years ago, I thought, okay, I got to read this a couple times, but let's go ahead. Hey, who was that person who read before? Was it Maria? Marissa, are you still with us?
Yes, I'm here. I'm here, yes.
How about, can you slowly read that last question for us?
Um,
It starts with, are you eligible?
Are you eligible for the refundable portion of the American Opportunity Credit? Answer no if 1, 2, and 3 apply to you. 1, you were A, under age 18 at the end of the year, or B, age 18 at the end of the year, and your earned income was less than 1/2 of your support, or C, a full-time student over age 18 and under 25 at the end of the year, and your earned income was less than 1/2 of your support. 2, at least one of your parents was alive at the end of the year. And 3, you are not filing a joint return for the year.
Okay, so I think in this particular one, I think the answer is yes.
So this question is asked in regards to the student, right? Not
Correct.
in regards to the taxpayer.
Correct.
Yeah.
All right, so we hit continue, and that should take us to. Okay, now if you had another student, then you would add that other student. But typically, what I've seen at the VITA site, 1 or 2 students. But again, and you might have a student who is not eligible for the American Opportunity Credit, and they are eligible for the Lifetime Learning Credit. And so that's why you select a particular credit. All right, we'll hit continue. And again, if you're working with folks who, and Sean, if you can hold off on this page, if you're working with folks who are going to college, that publication 970, it is a longer publication. It has a lot of examples. It does a really good job explaining the various credits. And I've learned a lot from the publication 970. Okay,
And
other things.
I was just going to mention, you could, if you're in TaxSlayer, you can type in form numbers here and it'll pull them up.
Good point, good point. So here are the various credits that you're going to see. And again, we talked about the child care. We talked about the education. That foreign tax credit, and you might see it on the 1099 INT. And what that means is someone is paying, they're paying, like I'll use my example. Years ago, I bought some mutual fund shares that invested in a Australian gold mine. I don't know why, but I did. And so I had to, at the end of the year, I had to pay Australian income tax. And so I paid Australian income tax. And then, of course, on my US return, I was able to get what is called a foreign tax credit for that income tax I paid to a foreign entity. So you may see that from time to time. And then another one, the retirement savers credit, you might see that from time to time. That's pretty much automatic when you enter information in the W-2. Residential energy credit, I've seen that a couple times before. So somebody might have something they purchased for energy conservation. And cursor down if you would. Let's see if there's anything at the very bottom that we need to point out. No. Okay, let's hit continue. And we're done with this. Just a reminder, the adjustments, you're going to see educator expenses. We talked about that, I think, last week. The educator expenses at the very top under adjustments, that would be K through 12, and that would be monies that a teacher expends on behalf of the children. Could be paper, pencils, and of course, COVID type items, and that would be a hand sanitizer, masks, other COVID items. So. And, for that matter, we got a little time. If you would, Sean, can you open that up? And
Educator?
yeah, educator. That's all you do. Now, if you have a couple, sometimes you'll have two individuals, they're both educators, K through 12. And then, of course, it'd be a total of $500 for a married filing joint couple that teaches. And then we'll continue. And other things that you see at the VITA site that I see the individuals who have, cursor down if you would, student loan interest deduction. And so if they're paying on a student loan, they're going to provide you with the document from the loan company, and then you'd plug that in. In 2021, if I'm not mistaken, tuition and fees deduction is gone. I rarely have used that in the past, but that I don't know why that's there, but that's gone for 2021. Okay, hit continue. And we'll hit continue again. And what else do we have? Let's go to our itemized deductions and plug in that amount that Gene donated to a charity.
I go back to
Itemized deductions. And so the only information we have for the Schedule A is Gene gave $700 to St. Killian's. That would be a cash gift. And so the charity is St. Killian's. And I'll throw this out to Mel. Mel, for St. Killian's, when people donate money, do they get some type of document from the diocese or from the church itself?
From the church itself, they do
Okay.
get a statement.
All right, and has letterhead and then does it have the tax ID number?
You'll get it
Yes.
at the end of the year. It'll be a summary of all your donations.
Okay, very good, very good. And then date of donation, she gave these $700 on April 26, 2021. And that was $700. And we'll hit continue.
But
And then,
what if there were multiple dates where they gave different amounts? But the total-
Yeah, if there's multiple dates, and if you can
Yeah.
hold on just a second, Sean, the only thing, you could add another cash contribution. Yeah, you could do that. But if you're giving, I don't know, if you give like 50 times a year, I think you're going to have to aggregate that. So, okay, hit continue. And let's go to just kind of a reminder, because we talked about this for non-cash gift. That second tab. And so if you're driving for a charitable organization, you track your miles and then you enter the number of miles, and then what happens is software will calculate your deduction. And then and I'm going to say this right, not you, Sean, but Scott. Scott mentioned something about the food bank or the food pantry at the church. And so if you're donating cans of corn and peas and carrots, well, then obviously that's a non-cash contribution. So if I remember correctly, we do that in VITA, but again, the individual's got to determine the cash value of those items that they're donating. We do not in VITA, we do not handle a situation where someone is donating real property. Could be a cemetery plot, or it could be raw land, improved land. We don't do that in VITA. They have to go to a paid practitioner.
And Jerry, typically, if you do non-cash donations to charitable organizations, you'll also receive a letter with the cash value of whatever you donated.
That is true. And of course, if you're donating items to Goodwill and Salvation Army, you want to determine that fair market value of the item that you donated. And there's a lot of ways to do it. There's information out there, but you don't want to donate an old refrigerator that barely works and say it's worth, $5,000. That's not going to fly.
Yeah.
Oh, okay, hit continue. And hit continue. Okay, we're done with the Schedule A. Let's go ahead and cursor through this and let's take a look at our return, our work product. And hit continue. See if there's anything here. Nope. Just a quick aside, Sean, if you can, to the very top. Again, you might have a self-employed individual that's making those estimated tax payments. And if they do, and it's highly encouraged, then of course they're going to come. I saw this at St. Killing's a couple times last season where people had made those estimated tax payments. And so that's where you plug in the federal and or state. Okay. And we'll hit continue.
Just a minute, Jerry, I got a question. Somebody's asking if there was a question about hybrid on the previous page.
Hybrid in reference to?
I'm not sure what it means. This question's from iPad.
Yeah. Yeah, we're going to have to get a little bit.
Probably means an electric car.
Oh, a hybrid automobile. Okay. All right. Because there's a hybrid method of accounting also. Yeah, if you have a car, you might be able to take the energy, what is it? The hybrid energy car credit, something like that. That's true. I've seen that, I think, once or twice. So, and if it's in the publication 4012, then by all means, if you get that question, tackle it. All right. Hit continue.
Continue.
All right, and then nothing that you need to concern yourself here. Again, if you have a decedent, we talked about this before, you'll fill out that form 1310. And Scott mentioned you don't have to upload the death certificate, and if the IRS asks for it, then of course a taxpayer, surviving spouse has it.
This is more if you're filling out taxes for a relative who passed away, then. Yeah,
and we had like great example. We had a mother that came into our site in Santa Ana. She lost her adult son, and the adult son had a refund coming. So we filled out the 1310, and then the mother received the refund that was due to the decedent. Okay. Okay, that's all we need here. Let's go ahead and hit continue.
And then Jerry, just a question. This taxpayer, we put their charitable contribution under the itemized deduction list. It didn't change their tax return amounts. Is that because we didn't put it in the cash part yet, or?
Yeah, we already did that. We're gonna go to the tax return. We're gonna look at our work product here. So hit continue.
Here we go.
And then you probably get a health insurance question, and she's not in the marketplace. And we're going to go through the marketplace, i.e. Covered California. We have that on the schedule for December 11th. State return's not available, so we will hit continue.
I was wondering why it didn't ask us if we had renters qualification.
I think they call it a work in progress. Okay, let's look at our work product and see if we are spot on. So we've got our taxpayer. We've got the qualifying widower filing status indicated. We have the son and the daughter. We have the amount of W-2 wages. We have interest and dividend income. We have that prize on line 8. Okay, cursor down a little bit. And then on line 10 alpha, it shows at $300. And 10 bravo, it shows at $300. And if you look at line 9 and subtract 10b, then it comes to, does it do it? I don't think it does it.
Well, they're looks like they're canceling each other out here.
Yeah, and I think that goes back to what I said earlier. I can't explain it. I've used this program for I don't know how many years, and sometimes you just get a wacky results. All I can say is they'll perfect it, and then when you're using the real software, it will be correct. Okay, so let's go back to what we do have. We do have the amount of what is called the AGI, adjusted gross income. And then we have a subtraction of $25,100. Now, I do know that a married filing joint or qualifying widower is 24,800. So that's the amount that it appears. Okay, so you subtract the amount of your standard deduction, you end up with your taxable income. Okay, page 2. Go to the top. And as I've mentioned before, and this is something I've shared with taxpayers for many, many years, the line 16, the tax, that's going to be computed automatically by the software. If you want to check that figure, you'd go to the instructions of the Form 1040, you'd look at the taxable amount and the instructions along with the filing status, and you'll end up with the amount of the tax. And then you can see here, we've got a non-refundable credit, which we're going to show you in a little bit. And the total tax comes to 0, line 24. And if you're familiar with negative taxable income, sometimes you will have negative taxable income in the VITA program. Your software is just going to take you down to 0. Let's see, we got withholding of $1,500. And so that means she's entitled to get that back. And then we go to our payments. Our earned income tax credit was calculated, that additional child tax credit, the refundable portion, which is 40% of the American Opportunity Credit, and then the rebate recovery credit or recovery rebate credit. So all of those payments and prepayments add up to $62.57. You add in the $1,500, you end up with and that's what I got. I got a check figure of $7,757, and that would be the refund for our taxpayer. And then Sean, let's do this. Let's go to page 3. And let's go to the top and see what we've got here. Okay, we've got the amount of that prize on line 8. And then we did not have any adjustments in part 2. Cursor down. Well, they did show that 300. Yeah, and I'm not sure why it's showing a negative 300. I'd probably have to do a little bit more reading. But anyway, it's there. We've done it properly. We've entered the amount of the charitable contribution. Let's go to page 4. And let's see what we have here. Okay, nothing. Just a quick aside, you will see this once in a while, and I mentioned this before. If you have someone in covered California and their situation has changed, i.e. their kid grew up, they had a kid, they got divorced, they got married, they moved, their income went way down or their income went way up, what they should do, they should go back to covered California, update the situation, because if they receive a subsidy, and that's what they're receiving, when you're in covered California, you receive a subsidy from the taxpayers. If your subsidy is too much at the end of the year, the government wants the money back. And that's that excess advance premium tax credit repayment. And that is, that's pretty traumatic financially when someone has to pay $3,000 or $4,000 back. So just remind them, update your covered California. Okay, nothing else here. Let's go to the bottom. And you can see the various credits, the child and dependent care credit, the education credit. Okay, and I think that's it. I'll tell you what, we do have some time, Sean. If you would, can you go ahead and generate a PDF? And that would be, yeah. And then I usually hit print and then it generates the PDF.
That's probably going to show up on a different screen. So,
but however you want to do it.
No, I mean, if you want to see it, I'm going to have to go share a different screen.
Oh, okay. Yeah. If you can just generate the PDF and see if we can show it, because like I say, we got a few minutes and we're familiar with looking at the forms themselves.
All right. Let's see where I went.
And then while Sean is doing that, again, just a reminder, we're not going to meet next week. On December 4th, we're going to talk about, in detail, we're going to talk about other taxes. to include self-employment taxes. We'll talk about the earned income tax credit. We'll talk about refunds, and then we'll talk about concluding the interview and quality review. I will address the concept of whole life and taxation of cash outs from a whole life policy. And then we will go through the John and Lisa Morgan fact pattern for 2021. And I'll get that out by, try to get that out by the end of next week.
Okay, Jerry, while I'm pulling this up for you, Barbara Harris has a question. She raised her hand.
Sure, Barbara.
Jerry, I got a question on the recovery rebate. All right. I got a different answer than you did, utilizing the same software for 2021. If she did not receive the recovery rebate, I think you had like, or the example had 2,400, where weren't they supposed to receive 1,400 per person in their household? And so my calculation that comes out on the tax return that I did calculates to 4,200, which changes the refund.
Did you say 4,200?
Correct.
And then what did you check that we didn't check?
We checked the same thing. I didn't receive the recovery rebate. And basically the third recovery rebate was 1,400, correct? So it would have been 1,400 per person. She's got 3 people on her tax return. Would that not have been 4,200?
That is 4,200. Well, it's interesting. So you and I checked the same thing. We got different numbers, and that's what I mentioned earlier. I can't explain it. I guess maybe a software guy or gal will have to explain it to me. But yeah, sometimes
I know when I'm training 20 people in the same classroom, they're not all connected to the same server that has that software in it. So they get different answers sometimes when we're in the training session. So I'm just trying to understand that the calculation should be 1,400 per person, correct?
I thought it was 1,400. Does anybody know differently?
I don't know.
Guess not. Okay. All right. I just want, I know that while you're training, the software is continually changing. So I have experienced that. So I just want to make sure whatever server I'm on calculated for 4,200, whatever server they're on today is calculating 2,400, but I'm sure it'll all work out when they release the software.
Barbara, you got to love it. All right, we are about ready to conclude. So let's see if Sean is able to bring up the software. I'm sorry, the 1040.
I thought it was already up there, but we'll try that again.
All right. Give it the old college try.
Are you seeing that?
Okay, I do see the practice lab. That's the PDF document. So we have Gene. So yeah, let's take a look at it. I'll just point out a couple things. There's a lot of data here, but
do you want to go to the 1040?
Yeah, if you're newer to VITA, you're going to see that facsimile of the W-2, and then that 8879 that Sean just went past. That's the document the taxpayers they do sign. And then what happens is once they sign it, if it's a married couple, then both of them sign it. Once they sign it, then of course that transmitter called the electronic return originator, that person then would e-file the return. Okay, then we'll go to the 1040. Okay.
Is this text big enough?
And yeah, that's big enough for me. Hopefully it's big enough for everybody. So on the 1040, we can see the AGI, which is 45,240. And then we can see the standard deduction and the charitable contribution. Okay. All right, so you got taxable income. Go to page 2. And again, we see the non-refundable credit gobble up that tax computed on line 16. So you have a total tax of 0. And again, the software here does not show negative taxable income. Okay, so we've got the various credits that we talked about. And then that's the number I came up with, the 7757. All right, next page. We've gone through the adjustments. Okay, next page. And then we've talked about these various credits. Okay, next page. Nothing here. Now, if you see the Schedule A, it simply means it's going to be automatically generated, even though she does not take the itemized deduction. And so sometimes, the taxpayer may get confused to say tax, it's just generated automatically. I don't know what you guys do. I don't know if you take this away, but I would just mention to the taxpayer, it's generated automatically by the software.
Yeah.
Okay, next page. Okay, your income and your dividends, or excuse me, your interest in your dividends. Okay, next page. Your child and Medicare expense credit. This confuses people from time to time because, again, they think their expenses equal the credit, and that's not the case. The credit is calculated based on those qualified expenses. And again, we talked about the refundability, which is a big thing this year. Okay, cursor down nice and slow and stop. And then you can see on line 8, it gives you that 50% factor. So in this case, they have a refundable credit, line 10, and that's at $1,200. And that's 50% of their childcare expenses. Okay, next one, your EITC. And we mentioned a couple of weeks ago, the EITC rules for 2021, they have changed. You now can get EITC below age 25. And if you are a senior citizen, let's say you're 66 or 68 years old in 2021, if you qualify, you can get the EITC. That 65 age limit, that cap has gone away in 2021. Okay, so we got the two kids. Yeah, we're not going to spend a lot of time there. Okay, go ahead and blast through this and keep going. And I think that's pretty much all. Yeah, there's the education credit. And again, you see the refundable and non-refundable portion. Okay. And yeah, next page. Yeah, I think we're done. I think that that's all we need to talk about there. All right. So Sean, if you had any questions from the group, we can entertain that for a couple minutes. Otherwise, I think we gave it a college try.
Well, let's see. There was just a comment that there's another way to create a print by clicking on the alternate method.
Yes, that's a good point. Good point.
Somebody asked if you can review the hybrid question and address it next time. Many clients have hybrid cars now.
Okay, I will put that on my schedule. And we're talking about the hybrid, basically the tax credit for energy efficient vehicles.
Yes.
Okay.
And then there's a question about when can we expect to receive the training, handouts, and exercise for December 7th. I think
December.
I think they mean 4th.
Yeah, December 4th. What I'll do is I'll send them out about a week in advance. And so probably by Thursday of next week, what's that? That's the Thanksgiving, Thursday or Friday. I'll make sure I get it out so you've got at least a week to work it. And you should keep in mind the exercise for John and Lisa Morgan. It will be a little bit more involved. And so that way we'll probably spend a good hour and a half on that return, entering data and discussing it.
And then I will, no matter how early we send it out, I'm always going to send a reminder for these Saturday training sessions on Thursday afternoon, because some people just get so many emails, they'll lose it if I send it a week ahead.
Okay, great. All right. Any other questions, Sean?
That is the last of the questions, Jerry.
Okay, well, I want to thank the folks that offered some information. I like that because I don't know everything. I really appreciate that. And I appreciate our readers. And then Sean, I appreciate you entering data into the software.
Well, Jerry, we all appreciate you getting a new computer. It sounded a lot better this week.
Well, thank you. It's working great, and I'm blessed. It works.
Hopefully, you get a write-off for that.
No, I'm just going to use it and have fun. So,
All
all
right.
right, folks, that takes care of it. I'll hand it back to Sean or Mel if you have any other comments.
Okay, I would just mention, I'm sure most people are already aware of this, but next week is Thanksgiving, so we won't be doing training next Saturday. If you missed any of the previous ones, they're all on the St. Kilian Church YouTube channel under the playlist for VITA training. And I send out a link to that at least once a week. This one's going to get up there later on today. I've got to wait for the church staff to post it. They usually get to that around 5 or 6 o'clock on a Saturday evening, and then we'll send out this link. And thanks a lot to everybody for attending.
Thank
Okay,
you.
everybody.
Guys.
you very
Thank
much.
you.
Take care.
Thank you.
Bye.
Thank you, Jerry. Thank you.
Thank you.
Bye.
Thank you.
Happy Thanksgiving. Bye.
All right. Goodbye, Jerry. I'm ending the call.